long-awaited Bitcoin-backed loans presentation. Yeah, well, let's just get into it. That's the title slide. This is the skip go, just buy, borrow, die. You guys have heard that, right? You guys have asked a little bit of like, how does the Bitcoin-backed lending work? And unfortunately, there's not really like there's like a lot of different ways that they work depending on who is offering the loan. But in general, it's you have your Bitcoin, you post it as collateral. So you send it to a company or the lender, right? And then they hold it and then they give you cash for it. So you're not selling it. There's no taxable event, et cetera, et cetera. So they can give you US dollar cash, but as we talked about stable coins, they can also give you USDC. And sometimes that's helpful because you can move the USDC faster, cheaper, et cetera. Depends on what you're trying to do with it and where it's going. And then there's two kind of options for payments or repayment. So one is there's a loan term and it might be 6 months, 12 months, 18 months, and you have the loan until the end of that term. At the end of the term, you just pay the loan back plus the interest. Or you do it like a typical loan that you're aware of now, which is they kind of pull those interest payments in. And so you're paying the interest every month. And then you just pay back the initial amount at the end of that term. So it depends on, and we'll go into like who offers what kind of repayments and whatnot. Then when you pay the loan back, then you get your Bitcoin back. But as you know, you can just keep cycling that. You don't have to take the Bitcoin back if you want. You can just say, well, I'm going to pay that back, but now I'm going to just take out another loan and you're going to give me cash. And then I'm going to use that cash to pay back that loan. So you can just keep cycling like that. I found this chick, Kristen. She's been kind of tweeting about her journey and experience of basically living the buy, borrow, die strategy. She's not doing it with all of her money, but she's doing it with a small amount of Bitcoin and just trying out this whole, let me just borrow it, pay it back with another loan, etc. So she says here she started with a 50% LTV. We'll get into that. And now she's at a 45% LTV because the Bitcoin price went up. So she could borrow more money to get back up to a 50% LTV if she wanted, but she's not going to because that's more risky to keep going back up to the 50%. Okay, so a couple of terms. So the collateral is the Bitcoin that you hold that you are going to send to the lender to secure your loan. That's your collateral. Same thing as like if you were buying a house and getting a mortgage, the house is the collateral. If you were starting a business, then whatever you're pledging as the collateral, that's like the future of the business. If you're getting a loan against your bank, Monique, like you have the collateral is your stocks and bonds that are in your portfolio. That's your collateral. So in this case, the Bitcoin itself is the collateral. So somebody else is going to hold it in custody so that they can get their money back. The LTV is just the percentage of the collateral's value, meaning what percentage of your collateral are you borrowing? So generally speaking, you can get higher LTVs, but it's much riskier. So safer LTVs are going to be closer to like the 20 to 50% range, or 30 to 50%, but whatever you feel comfortable with. Because Bitcoin is very volatile and it could drop 50%, you don't want to be caught not having enough collateral for the amount of loan that you have, because it's going to be a percentage of the price of the Bitcoin at that time, and you're borrowing the dollar. So the higher LTVs, like the 70% or higher, you generally see that in like mortgages. So when your collateral is a house, you can borrow up to like 70, 80%, sometimes 90% of the value of the house, because the real estate generally does not change value quickly. It's not very volatile, and it generally is going up and to the right over a very like slow period of time, right? So you're not, the lenders are not worried about that house like dropping in 50% value all of a sudden. So that's why you can borrow more. So then you have the interest rate, which again, you guys know this, it could be the interest rate varies though. For these Bitcoin backed lending, it is not like you lock in a rate and it's like that for the next 30 years. It's very variable. So then you have this margin call. You have to know what a margin call is, because if your Bitcoin is, let's say you have $100,000 in Bitcoin that you put up and you borrow 50%. So now you have borrowed $50,000. So now you have 50% LTV. Well, if the value of Bitcoin drops down to, let's say 60%, so now you're at or it drops to 60,000. So now if you're at 60,000, but you've borrowed 50,000, well, you're way over the LTV that the lender is comfortable with. And so they will sell your Bitcoin in order to cover the loan. So that's why you always want to have enough collateral in the account to prevent that from happening. So it does, if you're gonna borrow like a higher amount, like a higher LTV amount, then you want to keep a closer eye on it. And you can always add more collateral to the account to cover it. You don't necessarily have to sell the Bitcoin, but you may need to like add some more to that account. Does that make sense? So then there's the liquidation price. And this is the price at which the collateral will be automatically sold to repay the loan. There's a level at which they're like, hey, if it hits this LTV, then we're going to ask you to deposit more to your account or to pay down the loan. And then if it gets to the liquidation price, then they're just going to sell it all. So they do kind of give you a warning, but you don't really want to get close to that, right? So they will tell you ahead of time what the price of Bitcoin would have to be for them to liquidate all of your Bitcoin.
Does that price change as the price of Bitcoin changes?
No, because it's based on the dollar amount that you borrowed. So let's say you deposited the one Bitcoin, which, you know, has a price of $116,000 right now. But in this example, say it's worth 60,000, and then you borrow $30,000 at a 50% LTV. If they say 70% LTV is the liquidation threshold, then Bitcoin would have to drop from 60,000 to 42,000, and that's when they would sell all of your Bitcoin. So they're telling you exactly what value of the Bitcoin it would have to be for them to liquidate. And I looked at a couple of these different websites, and it seems like most of them include a very clear liquidation price. So it's easier to imagine, like if you're like looking at the numbers and you're not trying to like calculate numbers, because they'll just tell you like, oh, we're going to liquidate if it gets to 50,000. And you're like, cool, that seems pretty safe. Probably not going to go down to 50,000. So you're good to go. Great. And then the loan term, we kind of talked about this, but some of the loan terms are like really short, like 3 months. I have seen some that were like 3 years, but really most of them are going to be about 1 year to 1.5 year loans. Most of them are about 1 year though, so 12 months. There are some with open-ended terms, but generally speaking, those aren't the ones, those are going to be more risky and probably aren't going to be the ones that you would want to use. The origination fee is just like any loan that you take out. Sometimes they will charge a percentage of the loan amount. But it looks like a lot of the Bitcoin-backed lenders do not charge origination fees. So if you do see an origination fee, you might want to look somewhere else because there's a lot of different options that don't necessarily have an origination fee. So you'll save, if it's 1% and you're borrowing $100,000, you're going to be saving a good amount of money. Okay, and then custody solutions we've talked about custody too. We all are holding our Bitcoin in different ways, but when you're looking at a lender to borrow against, you want to understand how they are custodying the Bitcoin, because it's very important, because if they have poor custody of your Bitcoin, even if your LTV is in good health, if the company somehow fucks up their custody, then they lose your Bitcoin and you don't get that Bitcoin back at all. So you should definitely know how they are custodying it when you send it over to them. And there's a couple of it does get kind of technical, and to be honest, I don't really understand all the technicalities either, but it seems to be there's either that they put it in cold storage, and you guys know what cold storage is, or they use smart contracts to custody it. So those are going to be two totally different ways. I also found a third one. Actually, today I found one called Firefish, and they do multi-sig custody Bitcoin-backed loans. So you can't get it if they haven't been paid back, but they also can't just take your Bitcoin either. And if that company then went under, you would still be able to get your Bitcoin back. Anyways, okay, so there's 3 different ways that you can do the Bitcoin-backed lending, right? So you could do it through centralized finance crypto companies. So that would be like Coinbase or Ledin. These are centralized companies, crypto companies, that are accepting your Bitcoin in exchange for giving you US dollars or USDCs. That company takes on the custody, risk management, all of that, right? The other ones are like Nexo. Figure is another one. Figure is a big, they do mortgage lending and HELOCs as well. So they're just a big lender. Zappo Bank. Those are a couple of ones that I looked at. So then you have the TradFi Bitcoin-backed lending platform. So that's going to be the traditional finance institutions that are just now entering this space, and they want to be able to be involved here. So this would be like Fidelity giving you a loan in exchange for a Bitcoin, or Schwab or something like that, like a traditional bank. As far as I'm concerned, this is not really an option yet. I mean, I did this research last week and I didn't really see that as an option. The only way that this is kind of an option right now, as far as I'm concerned, guys, is that if you are holding Bitcoin ETFs in your brokerage, so at Fidelity or Schwab, because that's technically a security, you can borrow against that. But yeah, that's going to be the TradFi Bitcoin lending program. So we'll keep an eye on that. I would guess for sure that sometime late this year, early next year, that's going to become available. So you're then trusting your bank to hold your Bitcoin. So that's something to keep in mind. And whether or not that's FDIC insured, I don't know. TBD. These are a lot of regulatory laws that are kind of going into place now. So we'll see. All right, so then the third way is the DeFi, so decentralized finance, which is going to be like, it's not one company that's custodying it. It's kind of, this is where I don't really understand the technical details of how it works, but I've been told that it's a protocol-based lending on the blockchain, which means that no one person is custodying it, but you're using like a multi-sig, so the Bitcoin is available, but you're borrowing and lending to lots of different people, peer-to-peer type way. So I might post my Bitcoin collateral and say, hey, you guys can borrow my Bitcoin if I can borrow your US dollars, that kind of thing. So this uses smart contracts, and the smart contracts auto liquidate if it hits that liquidation price. So that's kind of why there's a benefit to the smart contracts. It's just like automatically processed. And the interest rates can vary widely on this one, very widely. So examples are like AVE, but I didn't focus on this just because it's a bit riskier. So I don't know how anyone's going to feel comfortable with this, but it's a lot of people who are kind of like trading cryptocurrencies a lot will use platforms like this. Okay, so I looked at a couple of different ones. The top ones, these are basically all centralized. These are all centralized lending platforms, the CeFi ones. And then the AVE is the DeFi at the bottom here. This is in order of the max LTV that the platform will allow you to borrow. So Zappo Bank has the lowest LTV. They will only let you borrow up to 40%, whereas Coinbase, Figure, and AVE will let you borrow up to 75%, which is quite high. And I don't recommend that. But those are your options. And 40% LTV is kind of low. So maybe that's not the best option depending on your goals here. And then the interest rates also, these vary, but you can kind of see that they're very varied. So 10.3, 12.4, 2.9, which is totally different. 10%, 12%. Coinbase is at 6 to 8% right now. Figure is 10 to 12%. So generally, we're talking, a pretty hefty interest rate, but it does vary. And then we've got loan term. So this is going to be right how long you can hold the loan before paying it off. So 12 months. Nexo is a lot more flexible. We can look at that. 12 months up to 2 years, which was one of the longest ones I saw. Coinbase again is like really flexible. I don't know if you ever have to pay that back. I can't remember. Figure also 12 months. And then some of these also have a minimum loan amount. So Strike actually has the highest minimum loan right now. But they keep lowering it. So when they first came out with their Bitcoin-backed lending program, the minimum loan was $100,000. And now, a couple months later, they've dropped it to $10,000. But if you were planning to borrow more than $10,000, really any of these companies would work for you. And then just for reference, so some of these are US companies and some of them are not, which may influence your opinion on, how protected it is or what regulatory laws it's falling under. But the first 3 are not US based. And then Strike, Arch, Coinbase, and Figure are all US companies. This is going into a little bit more of like what's happening behind the scenes once you hand over your collateral. But we kind of already talked about it. It's either the cold storage or a smart contract. And there are some that do the multi-sig, which would be a lot more secure. They do have risk management protocols in there. So they are, monitoring the price, monitoring your LTV all automatically. They usually will detect when your collateral is nearing that threshold, and they'll notify you or trigger a margin call or before you ever get to that liquidation price, unless it happens really quickly. And then if it goes from, oh, I thought I was fine to it dropped like from 20% to 30% to 40% in like, a couple days, that could catch you off guard. And then with the liquidation process, they will automatically sell. They will notify you if you're hitting near that number, but they will not notify you if there's not really any way that you can avoid them selling once you hit that liquidation number. Like, it's all automatic.
Okay, time for some real talk. Let's discuss the risks, because every revolution has casualties. And in Bitcoin-backed lending, that casualty was BlockFi, the firework factory run by blind toddlers that exploded in 2022 and lit half of crypto Twitter on fire. Let's not sugarcoat it. They took your Bitcoin, promised safe yield, and then loaned it to every degenerate leveraged hedge fund west of the 7th circle of Celsius. They turned customer deposits into unsecured IOUs backed by optimism and Adderall. When the market dropped 70%, the whole thing vaporized faster than Sam Bankman-Fried's dignity in court. What did we learn? Lesson 1, rehypothecation equals financial Russian roulette. BlockFi didn't just lend your Bitcoin, they lent it again and again and again, until your collateral had more clones than a Marvel multiverse. It was a collateral gangbang, and you were the last to find out. Now, we don't play that game anymore. The smart lenders, BitGo, Unchained, Anchorage, they use segregated on-chain vaults. Multi-sig audited public proof of reserves. You can literally see your collateral. It's like looking into the face of God if God was an algorithm and didn't give a single care about your credit score. Lesson 2, duration mismatch will kill you. BlockFi took 3-month deposits and gave out 18-month loans. That's financial suicide written in Comic Sans. Today's real Bitcoin lenders, they margin hourly. They don't let loans sit around like unsupervised toddlers with a lighter. If the price drops, you get liquidated faster than a Silicon Valley bank group chat. Yes, the state waddled in late, as always. California's DFPI fined BlockFi, made them issue refunds, and forced them to publish risk tables that even a goldfish could understand. Now retail lenders must disclose your loan to value, what happens in a flash crash, and whether your Bitcoin is chilling in cold storage or being gambled in Singapore by a guy named Trevor with a degree in business vibes. The SEC still doesn't understand what a note is, but at least now you can sue someone after you lose your Bitcoin instead of just crying into a Discord server full of laser-eyed victims. So yes, there are risks, but they're being dragged into the light. The worst offenders have been ritually sacrificed on the altar of liquidity risk. Now we're in phase 2, hard custody, on-chain audits, and lenders who actually fear God. Or at least Glassnode. This isn't your uncle's Ponzi scheme anymore, it's Bitcoin finance with consequences. Next slide.
When you're looking at the lenders, you just want to know what their risk management system is. How are they holding it? Are they rehypothecating? Are they not? How are they doing liquidation? Like, I'm not here to scare you away from it. I think that it's perfectly legitimate and tons of people do it. Just know that just know what you're getting into. Just educate yourself and make sure you know which company you're using and how they're managing that. That's just, yeah, even having gone through this BlockFi disaster debacle thing myself, I would still trust doing a Bitcoin backed loan. if I checked to make sure that the lender had the right risk management protocols in place and things like that. Oh, this was just kind of a fun fact as far as lending goes, but Fannie Mae and Freddie Mac were told to basically allow Bitcoin holdings as to be considered as qualifying you for a mortgage. So it's not just, this would have been helpful for me when I was trying to get a mortgage, but yeah, if you hold Bitcoin, you can say, yes, I have Bitcoin, it's valued at this much, and that can help qualify you for a mortgage. Like if you're holding it in Coinbase or Robinhood or something, right? Like you can show proof of funds through there. If you're holding it in cold storage, I don't know. Maybe, I mean, this didn't say we will consider all Bitcoin held in cold storage. They're saying it will be considered, but maybe if it's only held in a place where they can. To circle back to the traditional finance lenders entering this market, JP Morgan also, I forgot about this one, they were also considering offering loans against crypto holdings, but again, they still haven't. This is what I was talking about as far as the Bitcoin ETF backed lines. So Schwab, I already do this. So in Schwab, I have Bitcoin ETFs, and you can borrow against those ETFs, and you can borrow, I believe for me, I can borrow up to 60% against it. If you are holding a Bitcoin ETF like IBIT, Schwab, or Fidelity or something like that, you can get a line of credit against those ETFs. You cannot get a line of credit against a retirement account. You can borrow against a 401k. You can borrow up to 50% of your 401k or up to $50,000. So no more, you can't borrow more than $50,000 against your 401k, which is not much. But IRAs, traditional and Roth, no loans allowed. You cannot directly borrow against them. But I think it's like through your company, like an employer-sponsored plan, you can borrow against it through the company. You can't get a line of credit at a bank against a 401k. Yeah, some of the bigger banks are beginning to offer Bitcoin-backed loans, but those are for very high net worth. Minimum loan amounts starting $1 to $5 million. So that's going to be in private banking, which is not a retail bank offering for you guys. But what this does mean is that they're figuring it out, and I'm sure it would then start to roll out to retail clients should it be a lucrative market for them. So that's pretty much it. But there were a couple of other resources that I was gonna go over. One is this Bitcoin-backed loan simulator, which was kind of cool. Lead-in, which has the calculating how much you can borrow. Nexo has a credit card too. I don't know if Americans can get that, but it was kind of cool looking. And then there was also this lender called Firefish. They're also not American, but they're an example of a lender who they have lower interest rates, flexible loan terms, 50% LTV, and this is not, this is decentralized. So you're basically lending to peers. It's like a peer-to-peer lending situation. And there's no custodian per se, right? And they use a multi-sig setup to protect it. So then Lead-in has a calculator. So let's say you send 1 Bitcoin, then with a 50% LTV, you could borrow up to 59,000 at a 12.4% APR for 12 months. And then you would just pay that. You would just get another loan to pay that one back at the end of 12 months. Yeah, Coinbase also, they've been doing this longer, and it's only available on your phone. But if you open Coinbase, if you go to Coinbase Advanced on your phone, you scroll down under Transact, there's a borrow button. Well, so what I was going to show you is there's also a plan. So you could calculate that, let's say you have 1 Bitcoin, like your total holdings. If you were trying to use this as like a buy, borrow, die whole strategy, and you would say, okay, well, I want to be able to, that's probably like 15%. And you want to be able to spend just with 1 Bitcoin, we're just going to say like 2,000 a month or something. And then you can add a loan and say, I want to take a loan out to fund my living expenses. How much do you want to borrow? 2,000 a month. And then you're going to borrow enough to cover both your spending needs and the interest for the loan. And let's say that you wanted to start borrowing, let's say next year. We'll just say like August next year. It'll give you projected Bitcoin prices for that time. And then you can say, I want to do the borrow forever strategy, never pay the loan and just pass it on to your heirs. And then it will calculate all these numbers for you and tell you what your liquidation risk would be for that. This is very high because it's only 1 Bitcoin and that's not going to last that long. So for some of you who are thinking about that in like a long-term way, I don't know, maybe you say you have 4 or something. And when you change the numbers, it should change these risk numbers. So, and it'll tell you what the prices are. So it's assuming that the price of Bitcoin July 31st next year, it would be 276 for the bull case, 224 for a base case, and 66 for the bear case. So you could kind of say like, well, I don't think any of us are bears in here. So we probably wouldn't even expect that would be the case. So it's probably somewhere between this base and this bull case or something like that. So you would look at the base case and the bull case and look at the breakdown. I asked ChatGPT to come up with an interactive dashboard showing a perpetual Bitcoin-backed borrowing scenario. Okay, this is the interactive chart. This is the expected Bitcoin price. This is the dollar amount of 4 Bitcoin holdings. So it's basically this times 4 is that. Max borrowing capacity, right? So that's going to be 40% of this value is how much you can borrow. Loan balance is the total amount that you have borrowed. And then this amount adds in $5,000 of interest from this loan. So your loan balance is $50,000 in the first year. You have so this is you borrow $50,000 every year. The loan balance is, because it's perpetual, it means that this is just the balance of your loan as the years go on that you have not paid off. So that seems easy peasy to understand when it's like 10 years from now and your portfolio is over $4 million. That seems easy. But let's say like even in the next 5 years, right? So if this is 4 years from now, Your portfolio value is now 4 million. You can borrow 1.6 million, but you've only borrowed 385,000. You can borrow 185 and you're only borrowing 50. You can borrow 285, but you're only borrowing 105. You could borrow 400,000, but you don't need 400,000. So every year you could actually be borrowing more money. And what happens is, so it's perpetual because, so you borrow the 50,000, right? Let's say you borrow 50,000 today. Now you have 10% interest accruing on that. So in 1 year, you're going to owe 50,000 plus the 5,000. So 55,000, right? But what you do is by year 2, the value of your account has gone up so much that now you can borrow another $100,000 than you could last year. And so that means that you can just borrow more money. You just borrow another $55,000. You borrow $105,000, right? And then you pay down 50% of that loan, but the balance stays the same. Yeah, I mean, and it's gonna evolve. So, yeah, if you see any other Bitcoin-backed lending companies, just throw them in the chat because we all want to know what they are. So if you see anything that looks good, share with the group, because I would also like to see, because I didn't know that Firefish existed until today. I didn't know the People's Reserve existed until you told me. So